Hey, everybody, welcome back. I've got Jack with me. We're going to talk about your pensions and if they're invested in REITs, real estate income trust, or real estate investment trust. I looked at these a few years back and decided about that fast that I didn't want anything to do with them. I just prefer to have hard assets. That's what my channel is pretty much about, is hard assets. But people do invest in these. It's kind of like buying real estate through the stock market. Is that about how you'd put it?
Certain REITs, they're publicly traded. You can buy shares in them like you would in a stock. The ones that are making the headlines right now aren't so much the publicly traded ones. It's these private REITs, like the Blackstone one, and then another one this morning. We were talking about this last night over the phone when we decided to make this video. We were talking about how Blackstone, they're the B REIT or BREIT, however they want to call it, their private real estate investment trust had frozen withdrawals, and we were going to do the video about that. Woke up this morning to talk to you, did a real quick headline search, and it turns out Starwood is doing the same thing with their REIT this morning. They just froze withdrawals. So all that smart money last year, all that institutional money that was buying up real estate hand over fist, well, turns out now they're pulling a Hotel California with their investors, and they're saying, sorry, you can't have your money back.
Right. And keep in mind, Blackstone is enormous. I mean, BlackRock's huge. They're a what you call a traditional asset management firm, I guess you'd say. And Blackstone is a private equities firm. So that's the one all the pensions are in. And it's important to know that even though Blackstone is quite a bit smaller, like a 10x smaller, I think, they have 6 times as much real estate. So this is a big deal. And from what I pulled together, a normal, on average, a pension will have 10, 15, up to 25% of their money invested into real estate, and half of that is usually in these REITs. So this ought to be really interesting. And I got to give some props to Ninja, the economic ninja, because he kind of called for this a few months back. You remember that, Jack?
Yeah, realistically, Ninja first called this last year. He said all this institutional money piling into real estate was going to end poorly. So way out in front on this one. And it hasn't ended poorly yet. I don't want to be accused of fudding or anything too much here. Real estate values have not crashed yet, but this is one of those red flags. This is one of those indicators that the top is in. Bad things are starting to happen, right? These funds don't halt withdrawals for good reasons, right? They're halting withdrawals because people are trying to pull their money out, and it's going to affect the value of these assets.
And that was like the red flag for the Blackstone investors. These pension funds wanting to get out because the publicly traded ones were down 22.9%. The Blackrock ones. Now the Blackstone ones are like, hey, something's not right. I think we'll go ahead and get out. And that's when they limited withdrawals.
Real quick, just to high level, right? This is a private fund. So it's valued based on the net asset value of all the real estate in the fund at the end of the last quarter. All right. So as far as the value of this fund is concerned, it's still the end of September. Now, the last 2 months have not been very good for real estate. Home prices have started to dip a little bit. Again, they have not crashed yet. But earlier this year, this Blackstone, I'm sorry, it's really easy to get them mixed up. This Blackstone fund started to see a lot of withdrawals, particularly in Asia. A lot of Asian investors pulling their money out. Now, you may recall the Asian real estate market has been rather doo-doo for the last year or two. All right, now, when people pull their money out of these funds, what they usually have to do is they have to sell some of the assets within the fund in order to raise the cash to pay people back. Well, that has the effect of lowering the value of real estate. And so Blackstone has put these limits on how much of the fund can be redeemed every month. Blackstone says only 2% per month can be redeemed and a maximum of 5% per quarter. Well, they just hit the 5% for the quarter number in the middle of November, so they froze withdrawals. They said no more, because if anybody else withdraws money from the fund, we're going to be forced to sell some of our real estate assets, and it's going to be at a price that's not favorable. It's going to drive down the value of the remaining assets in the fund, because these are illiquid assets. And that's the important word here. The functional phrase here is illiquid. And
that
when you
is
have
true.
a fund backed by illiquid assets, a stampede for the exits can be very dangerous. And so they closed the gate.
And that's a big takeaway. When I talk to people that are, real estate's going to the moon and all this stuff, they don't understand how slow it actually is. When you start foreclosing, short selling, moving these rental properties or moving properties in general, it is a long, drawn out process. And we talked yesterday about what's going on in the new construction. The new construction guys are trying to sell these houses that are going down in value, and the people they have under contract are reneging on their contract. So it's such a slow process, and not to mention the people that are needing windows, appliances, all these things to finish the house so they can close on the house. If you've ever closed on a house, you'll know how stressful it is. You just want it done, usually both parties. But what's going on is these people are saying, hey, you're selling the same house in the same neighborhood, cheaper than what I got under contract, and I want that deal. Just know real estate is so slow. It is very, very illiquid. And we're starting to see the crash now. Most of the time people are like, oh, well, it's not crashing. It's got a lot further down to go to be like 2008. I hear that kind of stuff all the time. It's like, well, just wait. This could be a year out. We could be a year and a half out, literally that slow.
Now, I just want to point out, real estate on a good day is pretty illiquid, right? 2020, 2021, it wasn't the case. You put your house on the market, it sold in 2 days for $50,000 above asking price. It's not the case right now. They're spending more time on the market. And not just that, but there's a lot fewer transactions happening right now. Now, the prices haven't come down that much because the buyers and the sellers are leaving the market at roughly the same rate, right? So supply and demand are still relatively in balance, but there's far fewer transactions happening. And that means that this market is less liquid, because a year ago, if another 100,000 properties came on the market, it wouldn't have made a dent in prices because homes were selling so fast. There were so many buyers and so many sellers. Now, if that same number of properties comes on the market, it's going to drive property values down substantially, because there's only so many transactions going on right now. It's going to tip the balance way towards the number of sellers.
And what happens if when one person does that in the neighborhood, the people that are buying and looking to buy, they will just stop. Like, hey, wait, let's wait. Let's wait and see how far down this thing goes.
Yep.
And that is the cascade effect that I think that's starting right now. And it's interesting that Blackstone had to liquidate two of its properties in Las Vegas. And I'd like to talk about this for a minute, because this is really interesting to me. The surge in redemption requests comes as Blackrock announces the sale of its near 50% interest in MGM Grand and Mandalay Bay Resort. Now, they ended up with $1.27 billion. The deal was valued at $5 billion. So am I looking at that right, where it looks like they're taking a massive haircut on this property?
I've read a couple of different numbers. I've read that they made a ton of money on the deal, but that also included the income from the property over the last few years. So there's probably a little bit of corporate spin on what exactly happened and how much money they made on the deal. And if you include this or that, it makes the numbers look better for them. But the fact that they sold those properties now is probably a good thing for Blackstone, because selling a major resort in Las Vegas now, you're probably pretty close to the top. I mean, if they had held on to that property and sold it next year, they're not going to get nearly as much for it next year.
See, Vegas is dead, man. There's about half the people. I won't say it's dead, but I've been there a couple times lately, and it wasn't anything like what it used to be. And somebody in the comments, check me on that. I mean, if I'm wrong, let me know, but it just seemed like that when I was there. And as a real estate owner, a property owner, you always sell your poor performing assets first. You keep what you like, what performs the best in the better areas. And this being like the first one they sold might be kind of a red flag for that area. What do you think?
Definitely a red flag for the area, right? I mean, the Las Vegas Strip, they own the stake in the MGM Grand and the Mandalay Bay, I think, were the two big resorts, right? There's only a handful of these big monster resorts on the Vegas Strip, right? So two of those changing hands in a short period of time, that's a pretty big deal. Another thing you want to keep an eye on, especially with this Blackstone fund, is they're very heavily invested in industrial and logistics properties, transportation warehousing, right? Your digital e-commerce stuff. And think about some of the big stories of the last few weeks. We had FedEx announcing that they were furloughing workers heading into the Christmas shopping season. Amazon announcing layoffs heading into the Christmas shopping season. These are e-commerce giants. FedEx does the transport for the e-commerce giants. Normally, they're scaling up and hiring tens of thousands of seasonal help right now, and instead they're cutting. What does that tell you about the value of those logistics and those warehouse facilities? Right? Anybody who moves stuff right now will tell you stuff is not moving like it used to. Right? So keep in mind the way that Blackstone values their properties, the way they value the fund. They take the snapshot at the end of the previous quarter. So they're very slow to adjust the valuation of the shares in this fund. And if the value of the properties drops and people go to redeem it, it creates a big imbalance between what the fund is actually worth and what they market at. That can cause big problems for the fund manager.
To try to put this in perspective, I wrote some facts down. Blackstone is the largest private equity firm on the planet. So, there's that. That's a big one. The Real Estate Income Trust invested $85.2 billion in 2020 in new construction. They contributed 2.9 million jobs and generated $197 billion in labor income. This is a big black eye, 145 million Americans live in housing invested in REITs. And like I said before, Blackstone has 6 times the properties that Blackrock do, and Blackrock is enormous. So we're going to see more of this, just like you saw Starwood this morning. They're having their liquidity issue. And like I said, it took us 3 or 4 months to sell our rental properties. And that was a package deal to an investor. I mean, it takes a long time to move this stuff. And we got out before, this really started to happen. And things are still moving around here. We're not near as cyclical as Vegas and California and places like that. We're a pretty linear market. It kind of does this. Those other places do like that. So, guys, if you're waiting to buy a house, I think you're smart. Don't listen to me. I'm not a financial advisor. Don't do anything I say. You'll lose all your money. But that's what I'm doing. I'm going to cash. I know Jack is heavy in cash. Yep. I talked to investors yesterday all the time. I always ask people, what is the best move right now? What do you see? They're in cash. Every one of them, all the ones I respect, are holding cash and waiting for the deals to come, because in 2008, people were buying houses for 20 and 30 cents on the dollar. That's the kind of deals that I want to get the next time I get into rental properties. And I do plan on owning 100 doors. I do.
Look at it this way. The institutional money, right? What the people on CNBC might call the smart money, they're trying to get out. And the fund managers that have their money aren't letting them. So what does that tell you about real estate? It tells you real estate is overvalued. If people are trying to get out and they can't, that means real estate is overvalued right now. We all know real estate is overvalued, but now there we go. That there's undeniable proof. People want to sell but can't. All right, that means prices are going to go lower. That means there is pent up demand. There's pent up supply on the real estate market. People want to unload what they're holding.
And when I'm looking for signs of the top, and I've never called the top or the bottom, I got close. I know you did too when you sold your stocks. But like when people were bidding up houses, somebody asked $300,000, they'd get an offer for 310, 320, 330. I mean, it was like, that to me is a sell signal. That's when you're supposed to start selling, even though you think, this is good, it's going to go up forever, and you want to keep them. It was hard. It was hard to sell the houses that I had put so much work into, that I had fixed rate interest on, that I had renters in that never wasn't late one time on their rent. Well, I had one late, but I never missed a rent. She paid the late fee. It was weird. She would wait to pay the late fee every month. So it worked out for me. But I had a really good, you had to take your shoes off to go in. It was hard to sell those, but that's just kind of how you have to do it, is you try to sell when they're expensive. I think we're going to see this again in the mining stocks. Right now, they're extremely cheap, and I don't want to turn this on to mining, but I'm going to consider selling. I'm going to sell half of them when they rip. I'm going to get my initial investment out. We're going to play it super conservative and safe. I've worked too hard for what I got to lose it. And the rest, I'm going to sell about the time I see a gold bull ripping through the stock market on Bloomberg. You know, I'm going to, when everybody's FOMOing in and it looks like it's never going to come down, that's when I'm going to really start getting aggressively selling. And right now they're stupid cheap. That's the only thing I can think of that's stupid cheap is the miners. It takes the miners $19.33 to get a piece of silver out of the ground. That would tell me that there's a floor right there. So I know I'm not trying to go to gold and silver, but that's the next speculative bubble. This one is over and it's starting to come down, in my opinion.
I always go back to Exter's pyramid, that upside down triangle. The higher up the pyramid you go, the riskier the investment gets, the more total wealth there is up there. And then the further down you go, the less risk, the less total wealth. Well, we're talking right now about private equity, real estate investment trusts. That is a derivative of real estate. Derivatives is the upper echelons of Exter's pyramid, some of the riskiest assets you can own. That's where the failures always start, in the derivatives. We're seeing it with some of this crypto garbage right now, with these exchanges that are failing and these lending products that are failing. They're all derivatives, and real estate investment trusts may be the next. Real estate itself is further down the pyramid, and as those upper levels start to fail, you see a stampede down the pyramid for safety. All the way down at the bottom, that's your precious metals.
Yeah. Well, Jack, I appreciate you coming on and trying to make sense of this with me. I know there's not a whole lot anybody can do if your pension's going to invest what they invest in. But just know, this is why they print money. This is why they're going to print money again, 100% for sure, no doubt about it. They're going to do it to save your pension. They're going to do it to, pay the military. The same reason Zimbabwe president, what he told Doug Casey. Doug Casey asked him and said, "Why in the hell did you print all that money?" He asked the president that, just point blank. And he said, "We had to pay our elected officials. We had to pay, they had no other choice." And that's it. That's all they could do. So that is what they're going to do here as well. And you're going to see it. You're going to see it. It's coming. The pivot. I mean, they just started looking back. They did like this. They didn't even turn around. They're talking about 0.5 instead of 0.75 this time. So we're getting close, and it's going to be interesting. When it starts to happen, Jack, I want to have you back on to get your take on that as well.
Anytime, brother. Anytime.
All right, guys. Have an awesome day. We'll see you in the next one. Later.